The most successful investors and traders on the planet use fundamental analysis as their primary approach to finding trading opportunities, when to buy and sell. And there have even been institutional guys here on this channel that have described in great detail how they use fundamental analysis to manage millions of dollars under capital. All right, so today I'm going to give you guys the step-by-step daily routine that institutional guys use to do their fundamental analysis, so that way you guys can start to trade like the banks. All right, let's roll the intro. New to the channel, what's up? My name is Cleveland and I worked as a professional trader and analyst for 6 years. And now I'm here to bring you my daily insights on business, capital markets, finance, and more. Enjoy the video and welcome to the channel. All right, guys, let's get into it. We're gonna be discussing the step-by-step approach to doing your fundamentals, just like the institutional guys do. And if this video turns out to help you, even just a little bit, make sure you guys like the video. That would be very much appreciated. A survey was done by one of the biggest brokers in the world last year, and it asked the traders on their platform, what type of analysis do you do? And one was technical, do you do fundamental, or do you do a little bit of both? And the numbers were really what I expected. 85% of traders do just technical analysis, leaving 10% doing fundamental and 5% just doing a little bit of both, right? So most traders that trade a technical approach do it in all similar ways. They call it top down, right? Where they go from the higher time frames to the lower time frames. And what that does for them, allegedly, is give them a better picture view of what's happening price-wise on that particular asset. And you can make a case that that style of analysis gives you insights on what's happened progressively on that particular asset over time. But if that's the only type of analysis you do, then you're gonna have a very limited view on what's actually moving that particular asset. You're missing out on the big macro picture, right? And every firm job that I've ever had, there was never a guy in the office who kind of ran in and provided his insights from a technical approach where he says, guys, the market also just broke a trend line, so we should add that into the research report. No, there's never a technical analysis desk or someone who's just kind of sitting there doing, looking at different oscillators and indicators in the office and like that's his job. No, everyone has to have an understanding of the macroeconomics at the professional level. And so why is that the case? Why are there no technical guys? Well, technical analysis focuses on price. Meanwhile, fundamental analysis focuses on value. And fundamental analysts, they search for assets that are currently trading at prices higher or lower than their true value. So that's the interesting thing about fundamental analysis. It actually has technical analysis baked in, because you can't do fundamental analysis without technical analysis, because with fundamentals, you have to look at the price and then extrapolate from that price what could potentially cause that particular asset to be valued at where it's at. And anytime they see a misalignment, they realize there's a trading opportunity, right? So the best way to approach this, if you're looking at the macroeconomics of it, is to first start with the big picture view. So just like how the technical guys start at the higher time frames, the fundamental guys, they start with what's called the sentiment of the world economy. So the world economy flows in and out of risk environments where markets are risk on or where markets are risk off, right? Since we are now globalized, what's happening in any of the major reserve currencies is usually going to have some type of systemic effect across the entire world, right? And so that is going to give the general market a feeling or a tone. And this is where sentiment analysis comes into play, because now market participants can take a step back and you can basically read up and try to grasp how people feel about the general world economy and how that's going to affect currency prices or asset prices in general. So I'm going to put some resources down below that gives you that sentiment of the world economy. And that's something that you should look for on a daily basis. And eventually you'll start to realize that, oh, wow, globally people are risk on. They're excited. They feel like they can start putting capital at risk in more riskier investments like emerging markets or stocks and commodity prices. But when the market is risk off, then they're usually going to go back to the bond markets or to the treasuries or just go cash. And this affects the flow, the capital flow, and this heavily affects the currency markets. So you first have to understand the sentiment of the world economy, and then after that, you move on to the second step, which is being country specific, right? So each country is an economy of itself, right? That is going to have its own integral parts as to what makes that particular economy tick. Some economies are more service-based and manufacturing. Some economies are what you call commodity currencies, where the commodities are really what drives the strength or the weakness of that particular economy. And you have to be in tune and understand and comprehend truly why that economy ticks and what makes that economy either successful or not successful. And there are correlations between the sentiment of the world economy and individual countries. Basically, depending on the world economy and if it's risk on or risk off from a world view, that's going to affect in some ways how people are going to trade certain particular economies. And the US dollar is a great example where we've seen the US dollar rocket ship to the upside because of the view of the world economy and how global recession risks are affecting everything. And that is now causing the US dollar to be a safe haven currency. In isolation, yes, this might not actually be the case. In isolation, you might not have the US dollar screaming to the upside, but since from the nuanced perspective, the world economy is looking at the US dollar as the safest place to hold its capital during times of global risk, the US dollar is now surging in value. And each economy has those same nuances and even more finer detail than that, where each economy has a pressing catalyst. And that pressing catalyst drives currency prices quite dramatically. And that pressing catalyst is independent of any other economy. And that's going to be really important for you to understand what's the pressing catalyst of each major currency. And I want to show you guys the pressing catalyst that we capitalize on the euro. Let's go look at the charts. So once you understand the sentiment of the global economy, you understand that market participants are either risk on, they're excited to go into more riskier asset classes, or risk off. Everyone is fearing that there's inflation or recession. That's what's happening right now. Once you understand exactly where we are globally, then you can start to fine tune and start to understand exactly what each currency is up to. And of course, each currency correlated back to the economies there. And there's an amazing example that I want to show you guys related to the euro on how we isolated that specific currency to get a great trading opportunity. So earlier this year, February 22nd, I came out with this video where I mentioned that this currency is gonna get nuked. We were doing research inside of our community, linked in the bio if you guys want access to Top Trader University, where we go into great detail on how to do economic divergence and study up fundamentals. We were doing some pretty detailed research on why we thought that the euro was going to go fall into oblivion. And then just 2 days later, this happened, right? Russia invaded Ukraine. Now, the interesting thing is, when you guys actually look and see that particular situation, markets didn't gap down here on the euro. This is the 24th, right? And you guys can see that there was a gap, meaning that market participants were waiting for Putin to actually cross into Europe. So if you did analysis, you would have realized that Putin was arming his military to go into Ukraine all the way back in somewhere around December. You can even see a little bit of price manipulation here where market participants said, oh, because Draghi is speaking positively about the euro, we're going to start buying. No, we believe that this was a little bit of manipulation, only to have market participants do what they really wanted to do, the big guys, which was to sell the euro. Because no one wants to start buying the euro during the times where there might be a nuclear war with some of its neighbors, right? So on February 22nd, we pushed that video out. The 24th, we got the landslide sell, and that was just a pretty big opportunity for us. So that's an example of how you can use fundamental research first, trying to understand exactly what is the situation happening in Russia and Ukraine. Why are they going in? Russia didn't want Ukraine to become a NATO ally, and the entire western side of Ukraine is becoming more westernized, which is taking them away from this idea of, totalitarian government ideologies. And that is, of course, making, a country like Russia more and more uncomfortable, right? And so the attack into Ukraine was something that, of course, was very surprising to most market participants and caused a dramatic sell side move on the euro. And this is the euro index, by the way. I know you guys see euro USD, but this is our euro index, and we have indexes of each of the major currencies. The link for those are down in the description below. You're gonna have to use currency indexes to do this type of analysis, right? Most of the larger organizations and institutions, they trade with each currency index, not just the dollar index. Okay, so it's gonna be important for you guys to do that as well. So after you have the understanding of what's actually going on in any particular currency, you basically can start to price in the data, right? So you can go out to the monthly here and you can start to realize, okay, well, there are obviously things that are affecting this from an economic standpoint, causing it to be very choppy, obviously. But these factors are really culminating to having very trending moves. 2017, I remember trading back in this time where this was when Draghi mentioned that he wanted to see the euro much, much stronger. And at the same time, Donald Trump was mentioning that the dollar needed to be much, much stronger and that he could see the euro at 120 something on the euro USD, right? And so we actually ended up hitting right off on that level around that time. And then slowly but surely, the US dollar started to gain a lot of strength. So now you have the euro versus the dollar in terms of a currency war. Which currency is going to be stronger? Well, the US dollar ended up becoming much much stronger. And at the same time, the euro couldn't sustain. There was a lot of things happening. We just had the Southern European debt crisis back in 2014 that was really hurting the euro during that time. And that was only weakening the euro. So when the moment came where the euro actually hit off on 123, we slowly started to see it start to sell back down to this previous structure because of what we saw going on in the US dollar and that euro. So we were getting economic divergence, the euro getting weaker, the US dollar getting stronger. And that's the trading style that we believe all FX traders should adopt, or at least have an understanding of, because that is how the institutional guys play, right? They want to see two currencies going into opposite directions. That gives you the most powerful trading moves on the planet, period, right? If you guys want to know what's the most parabolic currency this year, it's actually the USD JPY. Why is that the case? Well, the US dollar is the strongest currency of the year. The Japanese yen is the weakest currency of the year. So you guys will see we are trading at the 104s. We're 3,000 pips away from that area, right? And so again, you guys can look at the Japanese index here, and you can see that the Japanese index this year, pretty massive sells. Let's go to the weekly so we can get a little bit of a better picture view. And you guys can see that it's just been selling off just consistently. Meanwhile, the US dollar has been doing nothing but the opposite. So technically the best currency to have traded this year has been the USD JPY because of economic divergence, right? So we have a full training on economic divergence, and that's our approach, period. We don't trade any other style. We focus down on that. The link for Top Trader University is below. That's a full guide on exactly how to trade economic divergence. And we also provide funding for traders who trade fundamental. So we also recently partnered with a firm here in Atlanta, Georgia, that's going to be providing funding to traders. That's also a really awesome opportunity. But we're really only working with traders that have gone through our training and that we know have a very solid understanding of how markets function, right? So that's going to be available for you guys here as well, okay? And I have an interview right here with Rob Loud. He's the head guy of the firm, okay? So if you guys have any questions, let me know. This is how the big boys trade. I hope this helps out. Comment down below if you guys have any extra questions, and I'll talk to you guys soon. All right, peace out.